All right. Okay. So hi, everyone. Thanks for joining us to our monthly educational webinar on crypto assets. This time, we have the pleasure to have our head of research, Pedro Lapenta, along with Dramane, our head of product, that the one who already joined know already well. So before starting the presentation, I will read the usual disclaimer. So this webinar and its corresponding presentation are for informational purposes only. It is not an offer to buy or sell, nor it is a solicitation of an offer to buy or sell. So that being said, the program today is to discuss what is behind the recent Bitcoin performance and what to expect next. So we have broke down the presentation in three parts. In the first one, we will discuss recent dynamics for the asset class. Then we will do a deep dive into the impact of US ETF on Bitcoin. And lastly, we will talk about the benefits of adding a crypto assets allocation to your portfolio and how to integrate this market within a traditional portfolio. So if you have questions, you can put them in the Q&A section, and we'll look at them at the end of the call. Roughly, we'll discuss. So to start, let's talk about recent dynamics. So maybe Pedro, if you can, maybe share a bit of our views and what you've been recently talking about with our clients.
Yes, thank you very much, Benjamin, and thank you everyone who was participating in this call today. It's a pleasure to be with you guys. So how do we start, right? This slide here is a summary of our view that has been predominant throughout 2023. We've put out a lot of reports and most of our calls, we've been discussing these 10 factors that we've been very vocal throughout the year of 2023, so far correctly. And we're just putting this as a background so you know to see where we're coming from and where we're going, right? Well, remember, 2022 was a very rough year for markets in general, not only for every risky asset in the world, pretty much, obviously crypto as well. But we had obviously, not only, like the strong increase in interest rates worldwide that affected prices of every risky asset, but crypto had its own set of circumstances, right? Mostly, the most notable one was FTX, the offshore exchange that played a vital role in the US market, and it was at the end of the day a fraud. You guys are aware of it, but it was an isolated fact, and that it didn't have anything to do with the technology and the other problems that we saw along 2022. 3AC Capital, and the other problems that we saw, they didn't have anything to do with the technology. They were most related to normal, I wouldn't say normal, but like traditional errors that we've people commit, and misalignment of incentives, bad behavior, bad risk management policies, but that had a tremendous impact on prices. But the technology itself didn't break, right? So when we look at these circumstances early in January 2023, that's when we started putting out this framework of secular factors and cyclical factors. We were like, okay, the technology didn't break. People are still using it, people are still adopting it, and people are excited about it. So we might be in front of a generational opportunity, and that's what we've been saying for the past year. We've been very vocal in all of our communications and all of our reports and our positioning, is that we might be in front of a very, very rare opportunity to invest in a secular technology that is developing in front of our eyes. So we put out this framework that we said, look, secular factors are like, this technology is here to stay. We think this is, the blockchain technology is something that are going to affect several markets. industries in ways that we have no idea yet, but we know it's going to be very impactful. So so we were like, the secular forces are still there. So the long-term trend is still there, right? So we were like, okay, the major networks, and we call it major networks, Bitcoin and Ethereum, each with its own set of characteristics, solving different problems. But these two networks are the ones who are like the older ones. They have matured, they have like strong communities, strong user base, strong activity in their networks. And so we call them, the major networks. So they were on path, to reach millions, eventually billions of users. So that didn't break, right? The second part was, the crypto value accrual has advanced. That's what I was trying to say when the secular thing was still there. If you compare it to 3, 4, 5 years ago, crypto is adding utility, it's adding more user base, it's adding more functions as the years go by. So the trend of value accrual was still happening, right? Bitcoin itself, value proposition, and we saw that during the US banking crisis with Silicon Valley Bank and the other banks. And then we also saw in a little bit in the UBS and Credit Suisse thing in Europe. It reacted, as a risk off asset when markets were having trouble with the financial system, right? So its value proposition was reassured, right? So that's a secular factor, because this is something that people are still betting on, that especially Bitcoin, it's eventually a risk off asset, right? Contrary to what a lot of people understand, and this is one of the opportunities. Regulation was still advancing worldwide, and we see that in several countries, and it was culminated with the US ETF approval early January. So we saw that trend continue. So we're like, okay, this is a secular factor in favor, right? And then when we saw what happened in terms of development within the networks and development in the communities throughout the crisis, we saw more people building and more people working on these networks than we had seen in previous cycles, like putting like a very interesting view to who's interacting with the technology, who's building on this. And when we saw it, it was like the world's largest institutions were building, right? So we're like, okay, the technology didn't die. On the contrary, there's all these aspects playing in favor for the secular factor. So these are the secular forces, that gives us the long-term view for where this technology was going, right? So we were like, okay, this is very interesting. And then we're like, okay, let's look at a more short-term factors, right? Is it a good time to buy? Remember, this is back in January 2023. Markets were like very low, and we were like, the secular factors are there, but do we have the moment? Is it the moment to buy, right? And then when we look at it, and remember, FTX was probably the most publicized problem of the crypto space in 2022 because of its characteristics. It was in the US. It had a lot of marketing. They were sponsoring teams. They were all over media and artists involved and all that. So they were very loud. But it was the last problem of the cycle. And when we take a look at prices and you look, what happened, once FTX had its issues, it seemed that it was losing impact, right? So it kind of made the low of the cycle. So we were like, okay, FTX probably was the low of the cycle. From there on, prices are going up and going up. So we thought, well, this might be a cyclical factor, right? And then you have remember, this is again last year. We were coming from a macro situation where US and Europe as well, and some countries in Asia were printing high single digits inflation numbers, right? So this was very concerning. People were we're speculating that interest rates were going to go all the way to, we don't even know, like 8, 9%. Some people were talking about these levels of interest rates in the US. But then we saw, a turning point, right? So it reached obviously very high levels, concerning levels. Fed started raising rates, obviously, a little bit in 2002, but still in 2023. But inflation pointed downwards. So that was another turning point, right? But again, especially for Bitcoin, we're seeing this issue in developed markets, especially again in the US, of ever increasing deficits on top of very huge levels of debt, which means that the US will continue monetizing its debt, and that's very bullish for Bitcoin, right? So another cyclical factor that continue. And then we were like saying, look, we were a bit early, but if you look at past cycles, the halving of Bitcoin, which is an event that's going to occur in 20 days or so, we're going to talk about it in a little bit, was we said, no, look, this is in the radar for the next year. This is going to be really important. So this is a cyclical factor that posts some interesting entry point for those who were willing to ride the long run. And in fact, that's what we've seen since then, right? And then we're going to show you, we have our own calculations of our long-term value. The next slide, Ben, if you may. Actually, this one, yeah, please. So this is something that we've put together here in the research team is to look at the combined market cap of Bitcoin and Ethereum networks, because they're the two main important ones. And we've run this regression, and this is a graph that we like to use. And again, just to explain it a little bit, the gray shaded area is where we gather data to train this model, and the blue shaded area is the projection, right? And the blue line is it's the combination of the market caps of Bitcoin and Ethereum, and it's really respecting what we've built, and it's now going back towards the fair regression line, or the trend line that this history of data points us, right? And this is a way to see where we are in the cycle, and we're looking at the very long run. And this gave us comfort that we were like, okay, we are at the bottom of the cycle, and correctly, this has been the case so far, right? So we were like, okay, it's Bitcoin and Ethereum, the two most relevant pieces, is below its fair trend. So from here, if all the bad things are priced in, it should only go up, right? So that's how we saw 2023, and we split the arguments into these secular factors and the cyclical factors, and we're like, okay, this is a once in a lifetime opportunity, right? It is very rare for these factors to combine together, and this is what we've been very vocal about it in every market that we are in. Look, guys, this is a generation opportunity. These are the factors. Please follow us, because it's rare to see this meeting of secular and cyclical factors, right? So, but then that was how we saw 2023. We are now in 2024, a huge run on crypto assets, mostly pushed by Bitcoin specifically, but we're still very comfortable and very excited about things that are coming. So I'll talk about the impact of the US spot Bitcoin ETF that was approved in January. This was a huge event for the industry, right? We have just passed by another major update on the Ethereum network that's called Dencun, okay? That's aiming at scalability mainly especially for the layer 2 networks that work on top of the Ethereum. It's going to bring way cheaper transactions and a much higher throughput. This is very important to bring new use cases into the network, right? So, but it was a network an upgrade that was awaited by a lot of people, and we just passed by this last March. We have now, in a few days, the most probably important event in crypto world, which is the halving for the Bitcoin network, and I'll talk about it in a little bit. And then in May, we're gonna hear from the SEC on either if they're gonna approve a Ethereum spot ETF in the US, and that's, I think it's an important event to follow, and obviously with some tremendous impact, especially now that we've seen the Bitcoin ETF tremendous demand coming out of the US, which is the largest market in the world. So this is a very, very important thing. And on top of that, we're seeing in the first half of 2024 probably the US at least pointing to some interest rate reductions, that's going to help a little bit on in the overall feeling of the market and obviously on liquidity as well. So that's why we think we are still in a very good position to continue invested in crypto, and the opportunity is still as big as we think it has always been, right? And then the halving, pretty quickly, you know, as you guys are aware, but you know, so I can explain a little bit. This is the mechanics of the Bitcoin network that guarantees at the end of the day that we're gonna have a limited cap of 21 million, right? So every 4 years, on average, actually every 210,000 blocks, the network new issuance of Bitcoin is divided by 2, right? So we're coming from 6.25 Bitcoins mined by the network for every block that is mined to 3.125 that's going to start happening in April, in 20 days, right? And then in 2028, approximately 4 years from now, this issuance is then divided by 2, and then 4 years later is then divided by 2 until we get to 2,140 approximately, and then the last Bitcoin will be mined, and then we're going to have achieved the 21 million cap, which is, in my opinion, and an opinion of many people, the main driver of the Bitcoin thesis, which is, you know, a true scarce digital asset, right? So this is the main mechanism. But the thing is that if you look at, when you look at in past cycles, and we plotted this graph here, and this is on a log scale, right? So the center line here is the date that the halving occurs, right? And then we get the window of 500 days before and 500 days after, and we compared the price action of the Bitcoin in these previous cycles, right? And then you can see the red, the green line is the first cycle, the purple line is the second cycle, the yellow line is the third cycle, and the one that we overlaid here, the blue line, is where is the current cycle, and we are very close to being to the halving occurred. But the point that we're trying to make here is that in the previous cycles there was a tremendous price impact by the event, and if we were to compare the current cycle to the previous cycles, we could say that we are probably a little up above the trend, but it's still following the same behavior, right? So we're seeing some price appreciation 500 days before, right? And this is index, okay? So 100 is the index. But the point is, like, if you look forward 500 days after the halving, there's still a tremendous price appreciation to come if history is to follow, right? So and then you can, Ben, if you can move forward, this is a long-term view of, obviously this is only Bitcoin, right? Of the phases, and the Bitcoin 500 days after and before is behaving just like in past cycles, right? And then when we look at this other way to look at it, it's that, you know, again, if history serves us with any information, the cycles are repeating like pretty much exactly the same pattern, right? So you have this 12 months of bull cycle, which is not the case that we are entering the bull cycle in the next months, I think, right? And this is where when we can see this 500 days after the halving. In the past 3 cycles, it lasted 12 months, and then obviously there's the bear phase, you know, that has lasted on average 13 months in previous cycle, and we are now in the recovery phase, which has lasted in the previous cycles from 22 to 23 months, right? So there's a coincidence of factors here, but it's still repeating. It's repeating again in this current cycle. So, and then you overlay that the fact that the US has finally approved the ETF in the US.
So on this point, Pedro, you know, we usually say that thanks to the US ETF, you know, the asset class is being institutionalized. So can you maybe comment a bit on these points?
Yeah, so this is the major driver because, well, it's curious because it comes after 15 years, right? And we're on year 15 of the life of Bitcoin, and only on year 15 that the US finally approved an institutional product to be, distributed to every single investor in the US. And remember, this is the largest capital markets in the world, and like the first days, the first 60 days or so since it was approved, we saw like a tremendous amount of demand. So this is the graph that we put together. This is the combined ETFs in the US. The net flows since it was launched adds up to roughly 220,000 Bitcoins, right? So that's only in the first 60 days of interest. And we know this takes time because the distributors are starting talking to the clients need to understand the risks. They start studying it. People weren't aware of it. Now that they have an institutional product, they have the means to do it. So they get the analysts start analyzing it, and then they get comfortable with it, and then they start with a small position, and then they increase the position. So all this is beginning, but the very first 60 days is a big impact. But not only that, this is a stamp of approval coming from the biggest regulator in the world and the most influential regulator in the world in the largest capital market in the world. So it couldn't be a better or a more important event for the industry as a whole, sacramenting, this new phase that Benjamin mentioned, which we're calling it, the new, like the institutionalization phase of the crypto assets. So we can call it a new phase. And just to make the last point on this is that, remember, we're seeing demand coming from ETFs on average from something close to 5,000, and we've seen 10,000 demand every day, of purchases, 10,000 Bitcoins of new demand every day. And remember, the network only prints 900 Bitcoins per day on average. So there's a huge imbalance of demand and supply. And this supply is going to divide by 2 in 20 days. So these 900 new Bitcoins that the network mints every day, it's going to be 450. And I think the demand is just beginning. So just to wrap it up, we think, this confluence of events, all these aspects, and since we're entering this new institutional phase, it's making us, continue very, very, very excited about the prospects for crypto assets, even though we're coming from a strong run in the past 12 to 15 months. So with that, Ben, we respect the time. I pass it to you, and then we go to Q&A.
Yeah,
later.
Absolutely. So we spoke a lot about Bitcoin and Ethereum, recent driver of performance and behavior. So maybe Dramane, if you can talk a bit about the integration and how can we look beyond just Bitcoin.
Sure, Ben. And hi everyone, and thanks for being with us today. I think as Lapenta was explaining, the success of the Bitcoin in ETF in the US really proved that crypto is finding and will continue finding its way in mainstream portfolios, right? I think for the longest time, we've been talking about that, every portfolio should have a small allocation to crypto, something between 1% to 5%, because that essentially enhances the risk-adjusted return of their portfolio. For a very simple reason, right? Small allocation to crypto would make the portfolio benefit from the outperformance that we know crypto for. And at the same time, because the allocation is measured, it will not blow the risk matrix of the portfolio. And by the way, crypto is a liquid alt and it's a diversifier. So essentially, what drives crypto tend to be very different from what drives the other asset class. So it adds all these benefits to client portfolios. And we've already seen some of the large asset manager adding crypto to their model portfolios or to the multi-asset portfolios. And I think that as these translate into outperformance for these strategies, I think more and more people would follow with having a small allocation to crypto in their base portfolio. So let's just look at some data based on what we have on screen here. We look at some data using our flagship strategy, which is the Nasdaq Crypto Index Europe, which is an index that we co-developed with Nasdaq as the benchmark for the market. And the results are very interesting, as you will see. A small allocation to crypto, let's say 1%, would help improve the annualized return of the portfolio from 6.6 to 7.4%, for instance. That's just, so 1% allocation to crypto increase the return by 12%, essentially. 80 basis points of 12% of what we had before. But the volatility only increased by 10 basis points. So that's 1%. So you allocate 1% of your portfolio to crypto, you improve your return by 12%, your volatility only increased by 1% of what it was prior. So that feeds into a much better Sharpe ratio for your portfolio. And by the way, the max drawdown doesn't move all that much, essentially. So making the point that that's a measured allocation to crypto, so it doesn't increase the risk of your portfolio all that much. And it's even better as you add more crypto to your portfolio. If you start with, if you were to do 2.5 instead, your return will go from 6.6 to 8.5. That is, almost 200 basis point extra. And how much additional risk are you adding to your portfolio? The volatility will move from 9.8 to 10.1. So that's 30 basis points. And again, I think that's really the value of crypto in the portfolio, because there's just so much outperformance that the asset class has been able to deliver that even a small measured allocation to crypto significantly improve the profile of the portfolio. And that's one of the reasons that we believe that over time, crypto will be a cornerstone of everyone's portfolio, because as certain wealth managers or private banks, without crypto, when you get benchmarked against your competitors that are just like 1% allocation to crypto, and your competitor is doing better than you by 100 basis points, I think that changes a lot of your way of thinking about crypto, and potentially enabling clients to do so, especially now that we have regulated product. So we built a series of tools to help you run this type of analysis on your portfolio. In particular, the Hashdex Online Portfolio Simulator that is available on our website, as you can see in the screenshot here on the right hand side of this deck. But if you move to the next slide, please. And I think that is super useful background, because I think it's been an exciting few months for crypto. But what the research team with Lapenta has built it's this chart that really shows how much crypto is a seasonal base, essentially. What you can see is like the crypto cycle tend to repeat itself every 4 years, essentially. And if you go back 4 years prior, if you go back to 2021, that was the last time that we had the bull market. Everything was crazy. Market went up significantly. The altcoin were leading in terms of performance, and in that type of scenario, altcoin has the better performance than Ethereum. That has a better performance than Bitcoin. But after that, these years of bull market tend to be followed by a bear market, and the first year of recovery, where usually Bitcoin is the asset that does better. And that's what we've seen in 2022 and 2023, where Bitcoin really led the market in terms of performance, essentially. But if history were to repeat itself, or at least rhyme the way it usually does, this year is the second year of the recovery, and Ethereum is the asset that tends to do better than. And after 2024, we will be in a full bull market where the altcoin are the one that do better. The reason why that matters is what we're hearing from a lot of client conversation is, we understand that Bitcoin had a tremendous outperformance for the past 14 months or so, But the conversation then becomes, what is the next trade? Because people have sort of internalized that the next trade might not be Bitcoin, but it's going to be a mix of Ethereum and some of the other tokens that are available in the crypto space. And that helps us make a point, right? We do believe that index investing is the best way to allocate to this emerging asset class. People should buy a diversified basket of crypto. And here is, the example comparing the performance of Bitcoin versus NCIE, the Nasdaq Crypto Index, which is the broad market cap index, over the past 4 years. And what you see is the NCIE would have yielded 72% versus 64% for Bitcoin. So there is a 800 basis point performance advantage for the basket strategy. And that is driven by what? That is driven by the outperformance of Ethereum and some of the other altcoins that are in this strategy. So as much as the NCIE will still have a large allocation to Bitcoin, 50%, 60%, the fact that 40% of it is allocated to altcoin generate a lot of outperformance. So indexing work in crypto, but not all indexes are created equal. And that's why we've spent a lot of time building this index that aim to capture the market and really grows as the market grows. The index today has there's 11 token in the index, but that is up from 8 almost 2 years ago. And the idea is really to have that dynamic way of capturing the market and give exposure to the emerging token as they come to the mainstream market and as they get more and more liquidity. So the index is built in a very robust and strict manner. And that's one of the reasons why we were able to avoid all the shenanigans that happened in crypto for the past 2 years or so. No exposure to Luna, no exposure to FTT, because the index is built in a very transparent and strict methodology that screen out all the tokens that might be subject to legal issues or, compliance issues and what have you. And so that's the approach to indexing in Europe. And on the last slide, Ben, please. That's a good way of closing the conversation. We also wanted to share with you that as of yesterday, our hashtag Bitcoin ETF is live in the US. As you guys remember, we're among one of the few firms that got approved by the SEC to have a Bitcoin ETF in the US. In fact, we had a product, a future-based product that we're allowed to convert. And now we are live and the product is available in the US. It's the hashtag Bitcoin ETF, designed to provide the exposure, to the mother of all the crypto, which is Bitcoin, essentially. And that is what you can trade in the US. And we are one of the few funds that have such a long track record because we've had this product live since before end of 2022, essentially. So the product is live and we're also going to be part of that increasing wave of Bitcoin ETF in the US as well, alongside all the other providers. So I'll stop here and then we can.
I have a question for you, Dramane.
Yeah,
so we talk about our flagship product, that give a market cap weighted evolutive exposure to crypto, as well as our Bitcoin ETF in the US that just give pure exposure to Bitcoin. But if we want to go beyond that, how do we present investing to client beyond just market cap weighted index?
Yeah. I think, one of the things, whenever we show the slide on the seasonality of the crypto market, I think one of the things that clients really perceive very well is, what was a great trade till now might not be the best trade for the future, right? So I think there's two types of conversation that we have with clients. It's either they invested in Bitcoin already or in NCIE, they had a good run, but they want something else. So they want to take some profit and allocate to something else. So maybe a tactical play. Or you have some people that are still not invested in crypto. They want to come now, but they are like, oh, maybe Bitcoin had a good run already. What should I be doing? And understanding that Ethereum and the altcoin might be the one driving the next phase of the crypto market in this cycle is very important. I think once they start zeroing into that, I think they really like the momentum strategy that we also have in our shelf in Europe. So basically, almost 2 years ago, we decided to build a momentum strategy. The idea was to offer a systematic approach to investing in crypto, whereby instead of just doing market cap weighted, we will use the price action of the past 2 months or so to create a portfolio. So the weight of an asset in a momentum strategy will be a function of how well the asset has done over the past few months. So that works such that in average in this strategy that would have 12 tokens, only maybe 20 to 25% will be allocated to Bitcoin and Ethereum. So it's really this strategy if you want to get an exposure to altcoin, because through it you'll get 75 to 80% allocation to 10 or so altcoin. And I think that's been one of the strategies that I think investors have a lot of appeal for, because they want the altcoin exposure, but they want it in a way that is systematic and sort of rule-based, instead of relying on transparent ways of approaching crypto, or maybe some of the active strategies that have not delivered better. So, and the beauty with this strategy is it's actually performed quite well versus the universe of hedge fund and some of the active strategies as well. So I think, yeah, momentum is probably the way I've seen clients try to allocate and play the coming, altcoin summer, if you will, Ben.
Sure, thank you. So that brings me another question that you touch on, maybe for Pedro. In this graph, we talk about the performance dynamic of Bitcoin, Ethereum, and altcoin. But let's put aside the performance dynamics. Pedro, do you think the altcoin, anything else than Bitcoin and Ethereum that are still major and has a large market cap, or are cheap today and maybe undervalued?
Well, yeah. The way to think about it, Ben, is in my opinion, is first, look at where we are in the cycle, and since we have two other long already, 4-year cycles to use as reference, we should, right? So this is something that we look at it a lot, but the other point is besides the cycle is to follow what's going on in these alternative coins, right? We call it altcoins, but there's a bunch of stuff happening in smart contract platforms, in decentralized applications, and layer 2s and all that stuff, and everything that we are looking at, and especially the larger ones, the ones that are part of this index, are seeing a lot of activity, a lot of new buildings. Buildings, I mean, people building stuff on top of these smart contract platforms, users gathering and using more network activity overall. And then if we're entering a new cycle where people start looking at this alternative coin, especially after a strong run in Bitcoin and Ethereum, we might see a lot of price appreciation coming to the other, on average, right, to the other altcoins. And one other interesting aspect is the relative sizes, right? Because the crypto market is still very, very concentrated into Bitcoin and Ethereum. When you look at it from a market capitalization perspective, Bitcoin and Ethereum combined adds up to close to $2 trillion out of $2.3 trillion for the total market capitalization. So any movement out of Bitcoin and Ethereum and into the altcoins is disproportional, right? So that's why we're probably going to see another huge run in altcoins coming up, and again, that's how we think the best way to get exposure to this is through the market cap weighted index, such as ours, NCIE, right? And through the index, since it's market cap weighted, you're not exposed to only one altcoin. You're exposed to whatever the market is telling us that it's the one that is developing, right? So And over the long run, that's very important because of the rebalances, because it removes everything. It removes the ones that are not working, and it includes the ones that are working. And then over long runs, and you can see that obviously in every market cap index, such as S&P 500 or Nasdaq 100 or FTSE or whatever, right? You might not be exposed to the one single company that outperformed everyone else, but on average, you're going to be exposed to this, much better trends than being exposed to only one token, right? And that applies to crypto assets, and that applies to normal assets. So I think that's the best way to go. And again, the cycle is in favor. Network activity, what's happening in these communities, what's happening in these networks is in favor. And then you have this huge relative valuation between altcoins and Bitcoin and Ethereum, or market sizes that support still very strong appreciation coming out of altcoins. I don't know if you answered your question, but that's how I see
Definitely.
it.
Perfect. Thank you, Pedro. And maybe I know we're a bit longer, but having both of you guys, is good opportunity to me to raise some the usual question that comes with clients at the moment. So we spoke about the halving. I'm going to go back in the presentation. But this time, it's the first time that we are reaching all-time high before the halving. So, Dramane, I want to ask you, do you think that the halving is already priced in? And do you think that this has some link with the US ETF, meaning more access today into Bitcoin?
Yeah, no, thanks, man. I think we hear that all the time. I don't think it's priced in really. I think there's something new, which is we read the all-time high before halving, but I think it's people underestimate the impact of the US ETF on all of these things. I think one of the numbers that Lapenta showed was like 215,000 new Bitcoin that is in stock for these ETFs, right? Think about the impact of that compared to the Bitcoin being mined today is 900. It's going to be 450 not too long from now, essentially. So that ratio in itself is ridiculously high in many ways. And I think for me, it's there's few things that are actually, one is the Bitcoin ETF launch in the US have been a tremendous success. So if you look at the top 30 new launches of ETF in the US, I think you have 4 Bitcoin ETF that are among that list, essentially. And they've been super successful, which proved that there was a lot of demand for Bitcoin ETF already. So this is not a niche product, and it's not going to stop. So that's one. And the second point that is very important is, even with this success, it's only a very small set of investors that have been able to allocate, because it's going to take time for everybody else to be ready to allocate. Maybe it's going to take 3 to 6 more months for most of the people that want to invest in crypto in the US to do so, because they need investment committee approval, they need to have the pipe and all this kind of thing. So despite all the success that we've seen, more than 12 billion, this is still a small set of people in the US that can invest in crypto. So that's all of this is to say that, Ben, I think it's still very early in the impact of the Bitcoin ETF, and that has been the biggest driver of the prices. And you just have to look at the ratio of what's the net new demand for Bitcoin because of this ETF, and compare that to the Bitcoin that are mined. I think even at the current level, you're probably close to a ratio that is over 10x, essentially. So it's like the demand for Bitcoin ETF going into ETF is 10 times higher than what the Bitcoin mine every day is. And I think that's a ratio that I really like to look at, and that makes me believe that this is largely the impact of this new product and not so much of the halving trade.
Perfect.
Yeah,
All right. Well,
I'll just add one last comment, Ben, if I may. That
absolutely.
probably we're gonna see in the next year or so, we're gonna wake up and open our websites and whatever that we follow every day, and we're gonna see like a major sovereign wealth fund or a major central bank announcing purchases of Bitcoin into these reserves, right? So they take time, but I bet we're going to see it in the next 12 to 18 months, like a major like a major investment fund, sovereign wealth fund, whatever, announcing.
I think the
like,
rumor is they have,
purposes.
but you don't know yet.
So,
the rumor is they have, and they don't know yet because they have no interest in telling you. They don't want the price to go any higher. But that's a good point, Lapenta.
We will find out.
That's the institutionalization phase. Thank you, guys.
Definitely. So thank you for your contribution, guys, and thank you to the audience. You know, you can find more information on our research, on our products, and also the online simulator on our website. Feel free to reach out. You will receive our communication and invitation for the next webinar. Very likely that we are going again to talk about the halving. So thank you, everyone, and see you next time. Goodbye.